Alrighty. So I've gotten a lot of requests to do another video on the income grid wheel strategy. So here it is. So this video is where I share with you the trades that I did the income grid wheel strategy on Amazon. Now, if you don't know what the income grid wheel strategy is, I strongly suggest that you go ahead and watch that previous video where I created the strategy on this first. I'll put the link at the top right hand corner of this video. So go ahead and watch that so you won't feel lost in this video. Alright, so let's get started on this video. So the very first question that you might have would be why Amazon, right? So first of all, you want to do your own due diligence on the stocks that you choose. And this is by no means a recommendation for you to buy into Amazon as well. So this is again just my own research, my own analysis. So for me personally, the reason why I like Amazon, well, first of all, it's a global leader in e-commerce, right? It dominates pretty much most of the regions in the world, and I'm pretty sure that most people have used Amazon at one point or another. So I definitely don't see it going bankrupt anytime soon, even though the prices have been crashing, the stock prices have been crashing, all right? Next is that it must have a strong fundamental, right? So for Amazon, I feel it has a strong fundamental because it has increasing revenue and profits. So as you can see, the blue bar down here is the revenue. You can see the revenue has been increasing very consistently over the years, as well as the net income, right? So as you can see, the net income has been increasing as well. So that is why I think this Amazon is a pretty good company. Now, next, what I look out for is that the assets have to be more than liabilities. So this way, you know that the company won't easily go bankrupt, right? Because if they have assets that's more than the liabilities, then you know they are able to pay off their loan or their any liabilities which they have. So as you can see, although the liabilities have been increasing, the assets have also been increasing as well. Now, next is that Amazon is now very highly undervalued because the market has been crashing. All the tech stocks actually are pretty much, most of the tech stocks are undervalued at the moment right now. So as you can see, this is the site on Simply Wall Street. Just go ahead there and just type any stock you want and they'll give you the valuation. So based on Simply Wall Street, you can see that the fair value is actually $198.51, and right now the current price is $83. So this is really undervalued at the moment right now, and that is why I decided to use the income grid wheel strategy on Amazon right now. Next is that the stock price has a history of increasing after every crash, right? You know, the Amazon has actually gone to over $1,000 in the share price. When it first started out, it was roughly, you know, not even $1. So you can see that even in 2000, the market has crashed, or rather Amazon has crashed 95%, but it has still gone all the way up. So Amazon is definitely no stranger to crashes. Even in 2008, the financial crisis, it crashed 66%, the market still went higher. So I'm feeling pretty confident that even after this 2022 crash, the market, right, or rather Amazon will still come out stronger. It will emerge stronger because it has this strong fundamentals. Alright, so next I'll get into the charts. I'll show you exactly how I plot the income grid levels, as well as when I exactly sell the cash secured puts, and also the premium, or rather the days to expiration, which option did I choose to place for this wheel strategy. By the way, if this video has been helpful to you so far, I greatly appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Alright, back to the video. Okay, so as you can see on this left hand side down here, this is a chart. This is the current price of where Amazon is around $92.50. So this is where I first started looking at Amazon, and that's where I started the income grid wheel strategy. So the next thing you want to do is how you want to plot your levels, right? So when you use the income grid wheel strategy, you want to plot all the levels in advance. You need to know exactly where you're going to sell your cash secured put. So you know exactly also what is the maximum cost, or rather the risk that you have to put into this stock for this strategy. So as you can see for this, what I've done is that I've started off with the $90 level, right? So this is my very first level, the $90, and I've plotted the income grid levels every $5. So every $5 down, I will have one potential cash secured put to sell. And the next thing you want to do is to identify the very last level. Where is the last level that you're going to sell your cash secured put at, right? So for me, I've decided at the $40 level. That means that the market has to crash roughly 80%, right? So $40 is roughly at the 21% mark of from where its high is. The peak is around $188 $1.65. So at $40 is roughly at the 21.2% level. So the market has a crash roughly 80% for me to get filled on all this cash secured put. And as you can see in the previous history, you can see that the market has actually crashed 95% before. 2008, 66%. So there is always the chance that the market can, crash all the way down to around $40, right? We never know. So I just want to prepare myself in the event that does happen. This way I can still keep selling premium, because right now in a market condition where it's a bear market, the market wants to crash, I want to put myself in a position where I'm not just stuck on one level, right? So that's one of the biggest problems which many people have in 2022, is where they sold a cash secured put. Maybe let's say, for example, they sold at $110 and the market just kept going down after that and it never recovered, right? So they have a problem right now because they are stuck with this level, $110, and they cannot even sell their covered calls because it's just too far away. So with this income grid wheel strategy, you're pretty much preventing this problem because you have grid levels all the way down, right? You have all this potential level for you to keep selling premium, keep selling your cash secured put and covered call. So imagine if the market was to just, bounce back and forth, like ding dong back and forth for the next, like what, 2 to 3 years, especially if you remember the period from 2000 all the way to 2010, it was a decade of sideways motion. The market never really made a new high for those 10 years. So in the event, let's say for example, right, touch wood, this happens again, at least I'll be in a position whereby I'll always be selling premium rather than just waiting for the 10 years later for the market to eventually go back up. Now, of course, I could be wrong, where the market could just, reverse and go all the way to high. So for me, that's fine as well, because I've already got other positions. I've got long-term stock holding. So while I do not make any money on this, I still have money on my long-term stock holding. So this way, I'm pretty much diversified in my strategies, hedged in this case. So if the market crashes, no problem. I've got this income grid wheel strategy working for me. If the market rallies all the way up, no problem as well. I've got long-term stock holding which will benefit from. On top of that, you can always readjust these grid levels if the market goes up. For example, right now, let me just remove this choice. Let's say if the market goes all the way back up, right? You can decide, hey, all right, I'll readjust my grids, right? This income grid level. So the first level is now $800, and then the next few levels, so on and so forth. So all this you can always just readjust and plan, and that's the beauty of this income grid wheel strategy. Now, for the income grid wheel strategy, next thing you want to take note of is the cost that you need to put aside for this. So for me, I've decided to put aside $80,000 just for this Amazon, because my account is fairly big, so I just dedicated a small portion of it to this stock for the wheel strategy. So for you, you want to decide yourself as well. The main thing is that you do not get caught in the position whereby you realize you run out of money once the market has gone all the way to this point, right? You realize that, oh no, I do not have any more money for this, or worse, you actually got filled on all this and you realize you don't have enough cash. And what's going to happen is that if the market continues to crash, you're going to get margin call, and then you need to put up more money, and this is where all the problems starts to arise. So the very first thing you need to take note of is what is the cost that you need to set aside to put up all the levels which you want for the income grid wheel strategy. Now, if you think that you don't have $80,000 to set aside for this strategy, you of course do not have to plot your income grid levels this way. You can always adjust them, right? So for example, you may say instead of a $5 grid level interval, you may do a $10 one. So this way, you have it at $90, you have it at $80, $70, so on and so forth, right? So you can go all the way back down also again to, in case the market crashes, 80%. And then you can see the total cost is about half of the previous one. The previous is $80,000, this is about $43,000. So you can still partake in selling the premium even though if the market crashes, right? Because you still got all these different levels that you can just keep selling your premium, sell your cash secured put, sell your covered call, all right? Now, what if you still do not have this $43,000, you still want to make it lesser, the cost lesser, then of course you can always adjust it. That means you do not have to put your levels to these two levels, right? So previously you can see we have the levels all the way to $40. This time you can choose, you say, hey, maybe I don't think the market is going to crash that much anymore. I think 80% is a little bit too exaggerated, especially now that Amazon is a much stronger company, a much different company compared to when it was in the year 2000, right? So I think that the market maybe at most will crash 70%, right? Or maybe even to 60%. So in this case, you might just say, you know, I just only want to go all the way to $60 or maybe $70. So in this case, you can see that the cost outlay that you put is only $30,000, which is much lesser than the one which we did earlier, right? So it is very flexible. It is according to your own outlook and also your own capital outlay risk factor that you want to do for this income grid wheel strategy. All right, so the next thing that you want to take note of or to understand is when and where do you sell your cash account put, right? So for me, I like to sell my cash account put once the price gets close to my strike, right? Some people like to sell it, you know, far away. Let's say maybe when the price is at $100, they want to sell it at $90 already, right? That is perfectly fine. There's no written rule to say that you must sell it once it's get close to the current strike price. But the reason I like to do it this way is because as the price gets closer to the strike price, I get more premium, right? As long as it's closer to your strike, the more premium you can get, right? So the other thing also is that because I have many different levels, right? I have at 85, I have at 80. So as much as possible, I want to wait for the prices to go as close to each of these strike to maximize the premium which I get. Again, this personal preference, you can choose to sell all these three or all these four at all the levels as much as you can at one time, right? Some people, they like to say that, okay, the market right now is $92, and then I want to sell the cash account put at 90, I want to sell the cash account put at 85, I want to sell also at 80. So this way they get all three premiums, much more premium than you would sell one by itself, right? That's perfectly fine as well. For me, again, I'll wait until it goes lower to sell, because if the market really does go lower, then you would probably regret selling that early, because you would have gotten more premium if you had just waited a while. Now, on the other hand, of course, the market could have just gone up, right? If the market really just bounced up, then you would have been better off. You have gotten more money, more premium if you sold all this, you know, 3 or maybe even 4 strike price at one time, right? For me, again, as you know, I like to sell it down here because the chances of you getting good premium at around, you know, the far out of the money strikes is very little, right? And if you want to get any decent one, you want to go very far out. Okay, now the next thing is that you want to decide which days to expiration you want to sell the options at your cash account put, right? So you have so many choices. Which one do you want to sell it at? So I'll pull out a few different choices. You can see you have the one at 2 days expiration where you get $77. You have the 9 days, you get $202. And then you have the one at 30 days at $360. So what's the one thing that you notice is that as the days to expirations gets higher, it's actually the premium actually kind of gets lesser because it's not proportionate, right? For example, let's say this 2 days give you $77. So if you were to just do a simple calculation, you'll notice that if you would take 2 days to make it to 9 days, the premium you should get much more than $200. So for example, right, let's say if you just take this premium rate at $77, you divide it by 2, and then you times 9 days, you should get $346.50 for this, right? If you were to take the same premium per day you get on this 2 days to expiration, but instead you get less. And you get even lesser if you go all the way to down here, right? So let's say, for example, you take the 9 days. 9 days times 2 will be 18 days to expiration. So by just a simple math calculation, you should get at least $400 or more if you're going to have the expiration date at 30 days away. But no, you actually only get $362, which is much significantly less than 2 times of this when there's so many more days out. So the thing with this you need to understand is that although the premium in terms of dollar terms is small, the return you're going to get is much lesser. So I'm going to give you a simple way for you to just calculate the returns you're going to get for each of this premium. So let's say for this, right? So remember, each contract has 100 shares, so 77 cents just means it's $77. So what you want to do is take $77, you divide off, right, by the cost which you're going to put up in case your cash account put gets exercised. So you have to put up $9,000 to be along 100 shares. Then you divide it by 2 days, the number of expiration date, then you times 365 days to annualize it. So if you annualize this, you can see it is 1.56, which is 156%. Right, so 156% based on this premium on this date. Now let's take a look at the one at 9 days, right? So again, same thing, you take $202, divide by the capital which you have to put up for this strike, 9,000, you divide it by the days to expiration, then you times 365 days to annualize it, and you get 91%. You notice this is much lesser. You get 156% for this, 91%. Now, 91% is still a lot, right? You get annualized 91%. You can imagine you can keep doing this consistently, which of course is not possible. You will get a pretty good return, right? Now, let's take a look at the one at 30 days. So this is where it really starts to drop in terms of your return, right? So you get $362, you divide by the $9,000, you divide by your 30 days, you times your 365 days. So now you have a 48.9%. So you can see the return drops, right? But your premium, of course, in terms of dollar terms is more. So which do you actually choose to sell, right? So the quick answer is that there is no right or wrong. You can just go for anyone which you want, right? So it really depends on your own objectives. So let's say, for example, if you want the highest return on interest, right, the highest return on your capital, then you definitely want to go for these 2 days, right? I've got some people who are telling me, saying that, you know, they go for the shortest time frame possible, the shortest days of expiration, because they get the highest return. This way they can keep selling the premium. Yes, that is absolutely right? You get much higher return, but the problem is that what if the market actually crashes after you sell that? Because if the market crashes and it doesn't come back up to your 90 strike price, then you can only sell this once, so you only got $77. And this is where you have regretted, because you wish you have sold two for this days expiration, the 9 days, because you would have gotten $200 for this, or you wish you have sold this because you got $362, which reduces your cost basis, right? So you never know what's going to happen, but of course it could just go up, right, expire, then it comes back down, you sell again, it goes back up, expires again, comes back down, then you sell, then you can just keep selling this. Again, we never know where the market is going to go. So for me, which one I chose? I chose the one in the middle, because generally I kind of like a good high return, but at the same time I do want to have quite a decent amount of premium. So in this case, I generally go for above $200 for this price level. So $200 is actually a pretty good premium, pretty decent premium for this. And also there's only 9 days left to expiration. So I sold this, and then let's just fast forward and see what happens. So on the expiration day, on 11th November, you can see that the market actually clearly expired above our strike price, so we gotten the full premium for this. So at this point in time, two choices. You can either just sell the premium right now at 90 strike price if you want to, if you're aggressive. I prefer to wait, so I waited until the market goes down. So when the market gets closest to my strike price, $90, this is where I start to pull out the option chain again and see which one to sell. So again, you have three choices. Which one you want is purely up to you. Right, I chose for the one in the middle, and in fact for this I actually got filled for $2, because at this point what I did, I put a limit order for $2, so as the market went down I got filled at $2, right? So I got $200 for this, right? So let's fast forward. So again, at expiration day, 2nd December, you can see that the market clearly closed above our strike price, so it expired. So again, two choices, either you can choose to sell now or wait for the market to go lower. So I waited for the market to go lower, and by this time you should know that I generally only look at the second closest option that is closest to expiration, right? So I do not really go for the first one, I go for the second one down here. So for this again, I received over $200. So again, you want to see what happens at expiration day. So expiration day, you can see it closed below our strike price this time, and I got exercised for the 100 shares. So now I'm long. I have to put up the capital of $9,000 to buy this 100 shares. Now at this point in time, there are people that actually ask me, do I roll this short put as it's close to expiration, right? Do I close this cash secured put? In this case, I actually do not roll the short put, right? I do not roll my cash secured put, and the reason is because when you're rolling this short put, what you're actually doing is that it's pretty much the same as if you get exercised and then you sell a cover call at 90 strike price, right? It's pretty much the same, all right? If this stock, Amazon, has a put skew, then you would get slightly more premium than selling a covered call. But for me, I do not want to roll my short put down here because my intention is to wait for the market to go up to around $95, then I sell a covered call at this strike price. Remember, when you are assigned on your stocks, there's two ways that you can make the money. Number one, you can sell your covered call immediately at the same strike price, so this way you just get the premium. The second way is by selling the covered call above where you're assigned at, so this way not only do you get the premium from the covered call, but you also get the capital gains from the difference of where you got assigned and where your shares will be called away in the event where the market continues to go higher, right? So for me, I prefer it this way, especially because Amazon is so undervalued right now. I don't think it's that difficult for the market to eventually go above $95. So this is where I'm headed towards. This is what my intention is for this, but it's perfectly fine for you as well if you say, hey, you know, you want to roll the short put to get more premium in case the market goes lower. That's absolutely fine, and that's your decision to make. Now, so I pull up the covered call down here. I pull up the call options down here to show you that you also have the option, right, to sell a cover call once you get exercise, right? So once you get exercise, you can immediately just sell the cover call at the 90 strike price and then get some premium here, right? If you sell the 7 days, you get $105. If you sell the 14 days, you get $173. All right, so totally up to you again. All right, so for me, I waited. So the market went down. So if you had actually sold the covered call down here at 90 strike price the moment you were assigned, then, well, you would start to make some money right now on your covered call because the market has gone down. All right, so the next step is to sell your cash secured put at the next level. So as you can see, I do this step by step, batch by batch. So at this point in time, again, there are two options. You can sell it, right, the 4 days to expiration. You can sell it at the 11 days to expiration. I'm pretty sure you know by now which one that I went for. So the one I went for, again, would be the one at 11 days. So I sold this. All right, let's just fast forward. And as you can see over here, the market has closed below our strike price at expiration, which means I've actually gotten exercise at 100 shares. So as of this recording right now, Amazon is at $83. So this way, I'm now long 200 shares. And again, I'm not selling my covered calls yet. I'm waiting for the market to have a bounce to go closer here. Then I'll sell my next covered call. So this covered call, if I sell at 90 strike price, would belong to this 85 strike price. And then if the market goes higher again to 95, I will sell another covered call at 95, which belongs to this $90 strike price. So that is my plan. So as you can see down here, as of this recording, I've got 2 positions filled. All right, this 2 cash secured put, and the beauty of this is that I still have so many more levels to go. So at this point of time, I actually want the market to go lower. Not that I'm a party pooper or that I want, you know, the market to crash, but I'm just trying to prevent myself from getting caught in a position. Let's say, for example, if I just had one level 90 and the market goes down, I cannot sell any more premium, right? So a lot of people are pretty much stuck at the position. I want to prevent that. So I prefer to spread it all out in different levels. So this way, as you can see, I'm actually excited if the market continues to go down, because this way I can make more money. And as you know, that as the market goes down, the volatility actually goes up. So as the volatility increases, the premium increases as well. So as the market goes down, I'll be making much more premium on all these levels. At the same time, my return is higher because the premium increases, but then the capital outlay, as you notice, is getting lower and lower as it goes down. And as it goes down all the way to the $45 and $40 at this point, and hopefully it does, right, I'll be able to actually sell 2 contracts down here, which increases my premium as well. So as long as the market just keeps staying in within my grid levels for this wheel strategy, I'll just keep selling premium over and over and over again. Alright guys, this is the income grid wheel strategy on Amazon. So I will encourage you to try it and make sure that you really plot out these levels first, and you know in advance what your cost is going to be, and that you have this set aside for this wheel strategy so that you do not get yourself caught in the position where you run out of capital and then you're going to get margin call. Right? So alright guys, I hope this video has been helpful to you. If it has, I appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.